Oh boy, do we have a good one. Welcome back to Strong Way in Personal Finance. I'm ready to make some videos. You want to know why? Because Joseph Carlson deserves it. So in this video, we're going to react to this amazing shilling of individual stock picking by none other than YouTube's large cap tech past performance buying hero clown, Joseph Carlson. This video is titled, "You Can Outperform the Market. Here's how." Really? You mean you could beat the market for a year or two or three? Wow, I didn't know that. That's new. That's a new revelation to me. So before I react to this, I just want to give a shout out to my boy Nick Doyle here, a fellow Boglehead who's much more classy, nice, and probably way richer than me. But he made a video responding to Joseph Carlson being an absolute freaking clown. The video's titled, "Is Joseph Carlson Playing a Fool's Game?" So make sure you subscribe to his channel, watch the video, and leave a nasty comment for Joseph Carlson. And a good comment for Nick. So let's go ahead and react to this freaking doofus, right? Oh, I got spiky hair like I'm in a boy band. Yeah, you're so freaking cool. You're such an icon, Joseph Carlson. And see what he has to say.
And I'm finally here addressing it. And that is the idea that you can't beat the market. I'm sure you've been told that a time or two since you started investing. Every investor's told that by many people. There's a lot of people out there, media outlets, money managers, different people that are bogleheads, a whole
Oh, you mean like me, Blosif?
segment of the market that has convinced themselves, and they're trying to convince others, that it is virtually impossible to beat the market. And by the market, they mean the S&P 500. Their claim is that as an individual investor, if you're picking out individual companies, creating your...
Well, first of all, the S&P 500 is not the market. The market is every stock in the freaking world, you clown.
portfolio, you really can't outperform the S&P 500. If you do outperform it for a month or a year or 2 years, well, you basically got lucky, or you took on a lot more risk and you just simply got lucky. And the people that have beat the market, the outliers, the pros, people like, well, Warren Buffett, they were just super lucky. They're one in a million. They're one of a kind. And you're not Warren.
Yes, statistically, over long time horizons. I've never said you can't beat the market in a year. Who says that? Over long time horizons, which is your investment time horizon, unless you're 70 years old watching this video and watching this boy band doofus here, you will underperform the market over long time horizons. The frickin' professionals can't do it. But you think this frickin' dork right here, with his ball trim software and his spiky hair and his little sign in the background and his large cap tech buying butt, do you think this guy is going to teach you how to beat the market? But I know somebody that beat the market over the long run, so that means it's very likely that I could beat the market. How many people have beat the market over 30, 40 years? Very, 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 very few. What more do I need to say? Okay? What more do I need to say? But we're going to keep watching.
Warren Buffett. So don't even try to be Warren Buffett. Don't try to pick individual stocks. Their advice...
You're not Warren Buffett, you freaking clowns. You probably have a full-time job. Joseph Carlson's full-time job is pretending like he has an edge on the market by buying large-cap tech. What a freaking loser. And convincing you to buy his ball trim software and to watch his YouTube channel so he can get ad revenue. That's the whole purpose of his freaking channel, okay? He has a fake job. Most of us have real jobs. And when you have a real job, you don't have time to pick stonks, okay? Especially if you have a family and kid. Doesn't he have a kid or something? How do you have freaking time? I'm struggling to understand with your freaking gym in the back. You see his little gym in the background? You think he uses that? Might as well change this to a rainbow flag.
Is to always buy low-cost index funds. That's the responsible thing to do. Since you don't know what stock is going up or down, you better just diversify and buy a little bit of everything. Buy a little bit of hundreds and hundreds of different companies. And over time, that will do better, being average, than investing in individual companies.
Yes, you will be better getting the average, because most people probably get below average returns. That's my guess right there, especially individual stock picking retail clowns that think they're smarter than the market. And when you buy an index fund, you're buying the stock, well, assuming it's a total market index fund, you're buying stocks at market cap weights because you're trusting the market over time to determine the appropriate price of stocks. Oh, just buy a little bit here and a little bit there and sprinkle your money everywhere. You're buying stocks roughly where they're priced. And if they're not properly priced, if you're dollar cost averaging over time, the market will figure it out and you will get an average price that roughly approximates a fair price for the stock. This clown is just buying large cap tech, and then he sprinkles in like Costco and Texas Clown House, and he pretends like he's a freaking genius investor. Or Chipotle stock, following Bill Ackman. What a freaking clown. Chipotle's AI, bro, because they have an assembly line. Wow. Yeah, I was so blown away by Chipotle when some freaking clown bursted my burrito open when he tried to close it.
Because at the end of the day, if you buy individual companies, you're basically gambling. You don't have the skills, you don't have the ability to tell what direction a stock is going. That's the
You don't, because it's based on future events, you clown.
Argument they make. Now, don't get me wrong. I like ETFs, and I think they're a great solution for the majority of people, especially those that aren't interested in investing or doing individual analysis. But what I reject is their notion, their idea that investing in individual companies is akin to gambling, that nobody can realistically outperform the market, and the idea that if you do so, you're simply just lucky.
You're not going to outperform the market. To beat the market, you need to have extra information that the market doesn't know. We live in the digital age. Computers can send information instantaneously. When a company announces earnings, do you notice you see a vertical line going up or down a lot? You know why? Because the information is processed so quickly that the market can react almost instantaneously to earnings. Do you think you have time to react to earnings as fast as the market does? Of course you don't. The market has an edge over you, you freaking doofus.
That paints a very grim picture for individual investors, and I think it's wrong. I think it's an inaccurate picture. What I'm going to present
because you want to sell your ball trim software.
In this video is a different side of things, one that shows a lot more opportunity, a lot more capability for individual investors to outperform. So what I'm going to do is address some of the biggest arguments they have that try to discourage people from picking individual stocks. One of the biggest arguments that they use to discourage individual investing is the idea or concept that only a couple companies are responsible for the majority of returns in the stock market. And unless you pick those few companies by either skill or luck, you're going to be left behind. I'm sure you've heard this before. The idea that only a few companies are responsible for nearly all of the returns. This is something that's not new. It's been told over and over again. Let's go ahead and even look at an article here. The 7 companies driving the US stock market rally. Now pay attention to that. There's only 7 companies that are driving this market rally.
Yes, because they're large companies, they are more represented in the index, and they have had good returns year to date.
Now, if we look at the article, we have the 7 companies right here. It is, of course, the Magnificent 7.
And of course, he's invested in those. What a freaking shock. Except for Tesla, I think, and maybe not Nvidia.
They make up a good chunk of the stock market, but they're driving the overall returns of the S&P 500. And this is what we're told as individual investors time and time again. Only a tiny few companies are responsible for all the returns, so what are the odds we have of picking out those few companies? It seems impossible. It seems like a daunting task. Do we really have the skills to select only a handful of companies that are going to outperform?
No.
The odds are that we're going to select some of the other 493 companies. We're going to underperform. Looking at this is extremely discouraging as an investor. You can come away with the belief that
And of course, he pulls up the S&P 500. Okay, there's, how many stocks are in VT? Like 9,000? This is just an index for one freaking country, okay? But this, according to Joseph Carlson, is the market. Yeah, the market is, 500 stocks, and there's like, 10,000 in the freaking world or more? What a freaking joke.
These 493 companies are basically duds. They're underperforming. And you have to have selected only a few companies. And they even go further with this. They give analogies, like investing in individual companies is like trying to find a needle in a haystack. So you have a giant stack of hay, and you're trying to find a tiny needle, the one company that will outperform the market, a virtually impossible task. But buying the index is like buying the entire haystack. That way you are guaranteed to have the needle in it. That's the analogy they give. Well, what if I had to say that this entire concept and this analogy of finding a needle in the haystack is entirely false?
What if I just bought the largest stocks in the index and pretended that I had an edge that the market doesn't have on the largest, most covered stocks in the index?
Been fed a falsehood by the media, by different companies, by money managers. When you're investing in individual companies, you're not trying to find some special needle in a haystack. Let's go ahead and take a look at the actual data here. First of all, we can start with just this year. We'll look at the S&P 500's performance this year. You'll notice that year to date, it's up 19.45%. So that is the market's performance. That
is not the market's performance. It doesn't include dividends, dumbass.
Haystack's performance. Let's go ahead and take a look at the needles in this haystack. Right here we have the S&P 500 component returns year to date. So this is a breakdown of every individual stock within the index and their individual returns year to date.
Year to date. Year to date. He is looking at a 1-year time horizon to prove the point that over long time horizons, you're not going to pick the long-term winners. What a moron.
Let's go ahead and take a look here. We have NVIDIA Corp with a 230% performance. Did that beat 19%?
Did you pick that? Did you buy that?
Yes, it did. So we have one that beat the S&P 500. This is one needle in the haystack. Then we
Oh, Meta. Did you buy Meta, Joseph? I thought, didn't you like crap on it when it was $80?
have Meta Platforms with 178%. That's another needle. We have Accenture,
Did you buy Accenture?
149%. This one is another needle. So far we have three needles that have not just beat the index, they've gone up, double, triple, quadruple, quintuple over the index. These are massive outperformers. They've gone up in orders of magnitude over the index. We have Royal Caribbean, the cruise line. That one's another needle. We have Holt Group, 93%.
You can't. Year-to-date returns are so manipulative. Okay, first of all, a stock could drop 90%, which is down. So you go from $100 to $10, and then it goes up 200% in a year or two. You're still well below the original price. Year-to-date returns are freaking useless. It's all about long-term performance, which is your investment life. 30, 40, 50, 60 years, you doofus. He's assuming that you buy these stocks right on January 1st or 2nd when the market's open. God.
Returns so far this year. Yet another needle. We have 92% returns with Palo Alto Network. Tesla, that's yet another needle that's outperformed the haystack this year, 91%. So far we have seven different needles that have outperformed the overall haystack. But we have 500 companies total, so this is still a very small percentage. But we keep going. We have AMD, which has outperformed 89% this year. Adobe up 84%.
I can read, nubnuts. What's your point?
Company number 15 is up 71%. But we can keep
I can read, Joseph. What's your point?
percent returns and above for all of these companies this year. We're up to company number 50. We continue down the list. We get to company 60. We're still above the S&P 500's returns. We get to company 70. Still above the S&P 500's returns. Up to 80. Still above. 90.
Just buy them on January 1st, bro.
100 companies, and we're still above the S&P 500's returns year to date, which is 19.45%. Investor. Now remember,
that is not the S&P. Oh, he's so stupid.
the S&P 500's returns year to date is 19.45%, meaning that right now, as of today, there are exactly 129 individual stocks in the S&P 500 that have outperformed it year to date. 100.
Okay, so that's like what, 23%? So if you technically buy on January 1st, the top 23, the best 23% companies, you'll have better year-to-date returns in the S&P 500, but I'll ignore dividends. Wow, your chances are really good. The top 23% every year. It's so easy, bro.
129. All right, so we have 129 companies that have outperformed the index. That means that roughly 25% of the stocks in the S&P 500 have outperformed the S&P 500. 1 in 4. Now that seems a lot less intimidating, doesn't it? I mean, come on. I don't have the confidence to select a needle in a haystack. Trying to find a needle in a haystack seems incredibly intimidating.
Yeah, so you just buy large cap tech. You're a genius, bro.
And near impossible. And if that was the case, they would be right. It would be virtually impossible. But that's not the case. 25% of the companies in the S&P 500 have outperformed the index this year, year to date.
Wow, those are great odds.
So selecting the stock is not akin to finding a needle in a haystack. It's akin to finding a needle amongst 3 other strands of hay. That is what the stats show this year. Now, we've looked at this year alone, and you might make the argument that this year is special or unique, and typically it's more difficult for individual stock pickers. You'd be wrong again. In fact, 2023 was an unusually difficult year for stock pickers, far more difficult than most years in the market for.
Okay, so percentage of stocks outperforming the S&P. So you can see that there's much higher percentages, right? So it's like, I actually have a 45% chance. No, the stocks keep rotating. And in order to match this, you have to sell at the end of the year and then buy the best stocks for the next year over and over and over again. And oh, by the way, you're paying taxes on that too. The stocks on here freaking rotate. It's not the same stocks, except probably large cap tech, okay? This guy is a freaking clown. So let's keep going. Let's see what else you... Oh yeah, see, it's so easy, bro. Buy my ball trim software.
We try to tell you that there's only a tiny select few of companies that outperform. But we're looking at the numbers, and typically, on a typical year, 40 to 50% of companies outperform the overall index. 40 to 50%.
On a typical year, numbnuts, a stock could drop 90% and then have a small rally that still doesn't recover initial losses.
Is not a tiny sliver. That's a big chunk of companies. That's hundreds of companies in the S&P 500 every single year. So as an individual investor, as an analyst, your job isn't to find the 1 or 2 companies that will outperform. It's to find any company in that group of 40 to 50% that will outperform the other 50 to 60%.
Oh, if you're just an analyst, so you get up in the morning, you take your kids to school, you go to your job, you come home, you hang out with your kids, you make dinner, you hang out with your kids some more, you put them to bed. Oh, it's 7:30, 8 o'clock, time to do my stock analysis. Let me put on a Joseph Carlson video where he talks about large cap tech. Yeah, you're a freaking analyst, you doofus.
It's still a task. You still have to do work. You can't just guess at it, but it's far more achievable than the picture they try to paint. There's a big group of companies outperforming the market. Now, there's other arguments they make. Like we look at this right here, where the S&P 500 market cap index has outperformed the equal weighted index. The equal weighted is as if you put every single company at a 1% weighting or a 2% weighting. Everything is equal weighted. You don't weight Apple.
Yeah, that's the correct weighting for the S&P 500. Take 500 and divide it by 100%.
Any bigger than you do any other company, like Vici. They have the exact same weight despite their market cap. In 2023, the market cap weighted is outperforming the equal weighted because of the Mag 7. Those companies have done particularly well. They're up 50, 60, 70%, and they have such huge weighting that they're dragging up the market. The equal weighting, on the other hand, has been basically flat all year. According to JP Morgan, the average investor earns only 2.9% a year, which is really pitiful performance.
Oh, wow. So we have actual data that proves that individual investors suck, but it doesn't matter, bro.
This is the average investor. Now, JP Morgan doesn't go into what the average investor is, but I assume that's any individual investor that has bought an individual stock, any in their portfolio.
Joseph Carlson viewers.
And this is what I want to address. Why so many individual investors underperform the benchmark. There's a couple big reasons why. The first reason is that the average holding period of a stock from an individual investor is at a nearly all-time low. We have all these new...
Yes, and you just advocated having low holding periods because what you said is you want to pick the stocks that outperform each year. So in order to do that, you have to hold very short term and reallocate your portfolio constantly, paying short-term capital gains taxes in order to pick the stocks that outperform each year. He just shot his own argument down. God, he's a freaking moron.
New investing tools like Robinhood, we have Webull, we have all of these different places where you can invest for free. And those free trades make it so investors trade very frequently, impatiently. They buy into stocks and sell them within a year. A 10-month average holding period is incredibly short. That is basically gambling. So the average...
You know how you don't do that? You buy an index over your working life. And my holding period for VT started in 2012. Crazy.
Investor is not really an investor at all. They're gamblers. They're not buying into businesses because of their fundamentals or future growth prospects and cash flows. They're buying into them because of speculation. So this is a group of so-called investors that get grouped into the statistics and lower the performance of the average overall. But don't be mistaken. But
if you're one of the elite investors that signs up for ball trim and looks at past historical performance, you too can beat the S&P 500. But make sure you pick the stocks every year that beat the S&P 500, which constantly rotate.
Average holding time of 10 months does not make you an investor. You're not buying stocks because of due diligence, analysis, or look at the fundamentals. You are speculating on price movements.
And he talks about looking at he doesn't even know how to read the statement of cash flows. Mr. Joseph Carlson, CPA. Guy's a freaking Oh yeah, stock-based compensation. That's a financing activity. You should add it back on the financing cash flows. He doesn't know jack all about financials. I'm a trained accountant. I know what I'm freaking talking about. This guy doesn't know jack crap. He's just a dork that never works out. It's freaking bench press in the back. This is a freaking joke. I can't stand this.
Doing so has been proven time and time again to be a losing proposition. In my portfolios right now, my average holding time is 29 months. So almost 3...
Wow, that's so amazing. Mine is like what? Well, I guess if you average it, I guess it'd be half my investing lifetime. But it's much higher than yours, doofus.
Times the average investors today. And that's with a portfolio that's 5 years old. As I continue to age my portfolio, my average holding time will continue to go up. But obviously having 3 times the holding period gives me an advantage over speculators. But that's a big reason why individual investors underperform.
Yeah, tell that to Jeremy, tattooed chef.
A huge group of them aren't really investors, they're speculators. Another big thing that feeds into underperformance are a lot of biases that we have.
My husband's family is Greek, and I've always wanted to become fluent to grow closer to my in-laws.
For example, we have recency bias, where we invest in the latest and greatest thing, and we forget about the fundamentals of a company. It is normal human behavior to try to bypass performance.
And he's buying large cap tech. Look at all the stocks he buys. They're all up massively.
See stocks going up, and we want to buy the performance that they recently had. But you can't do that in investing. You have to buy stocks when they have good value and good future. When a stock goes down in price, its future expected return goes up. But it's normal human behavior to buy companies that have recently risen from low prices. This leads to underperformance. So with the combination of very short holding periods, plus buying whatever recently went up in stock price, it's no question of why individual investors have such poor performance. They have a poor investing mindset and strategy, and overall that drags down their performance. Another reason that I believe contributes to underperformance is not truly knowing what they own. Peter Lynch says to know what you own, meaning
and here's this up. Buy my ball trim, bro.
Know the products they sell, know their fundamentals, know what their growth looks like over a long period of time.
Past performance, okay.
Know what their cash flows look like and their balance sheet. Understand.
Yeah, you know what the cash flows are, you freaking doofus. You've already proven. I have literally shown with incontrovertible evidence that you don't know how to read a statement of cash flows. I could literally make a statement of cash flows on the cuff. Can you? No, because you don't understand it, dork.
Understanding this stuff is important. I offer Qualtrim.com, which is a service that I sell. But even if you don't use Qualtrim, there's other options. Use
I wonder what the whole point of this video is. Talk. Oh, here's my ball trim.
Yahoo Finance, use Seeking Alpha, use something to know what you own. And if you're not willing to do the fundamental analysis or look at a stock, then don't buy it. Buy the index if you're not willing to look at it. Because if you're not going to
After you work all day and take care of your kids, just look at a stock, bro. Buy my ball trim.
look at what you own and the fundamentals of it, you're going to underperform. I think as investors, if we have more thoughtful analysis on the companies we own, if we actually understand the fundamentals of what we're buying, as well as if we avoid recency bias, we avoid buying whatever's hyped up and whatever's going up in price,
Large cap tech.
and if we have longer holding periods than the dismal 10 months of the average investor, all of that will increase our chances of outperforming.
Okay. Do you guys, I mean, oh, I love roasting this clown. You guys think he's cool? He's okay. I mean, he's not super bad like Jeremy. He's just as freaking bad. He's still convincing you to buy individual stocks when he showed the evidence that individual investors underperform. He used manipulative time frames to prove his stupid, fallacious point, and he wants you to buy his ball trim software. Get the hell out of here, Joseph. Lick my tattoo trucker sweaty you-know-what. Cheers!